Lyn, how are you doing?
I'm good. How are you?
I am really good. I've got something to tell you.
What's that?
So, remember last month when we were talking about yields, and afterwards you sent me that chart with the yields going up, essentially
Yes.
breaking, and I was like, "Wow!" Like reading the comments about it as a disaster, but I was like, in my head, I was like, I don't actually understand why this is bad, because surely if yields are going up, this is great. There's better interest rates, people are going to be making more money. And I then had a session with Greg Foss, and in preparation, I actually went and did some reading. And what I didn't realize is that with the bonds, there's this whole, they were constantly being repriced, being bought and sold in this market. And I didn't realize that obviously if the bond yields are going up, all the old bonds they're losing value at the same time. I had
Yeah.
no understanding of that. So I just nodded and agreed with you, and I was thinking, shit, I don't understand this.
Yeah, and there's a couple levels there because one is people on those long bonds lose value, existing
Yeah.
holders. I mean, people that are buying now get a better deal. And then two, it ripples into other asset classes as well. And so it's one of those things where normally higher interest rates would be a good thing. It helps basically
Mm.
keep a time value to money. It's a really important thing to have. But because they've driven interest rates so low, we've had such a buildup of debt. And then therefore, when those interest rates try to rise, when you have extremely high debt levels, that causes all sorts of solvency problems, liquidity problems that are important to watch out for. And then two, because we have equity valuations that are so high, especially in the growth and tech stocks, so those are if you do the analysis of like discounted cash flow analysis, you're trying to determine what is your discount rate. So what is your expected rate of return?
Yeah.
If you're in an environment where treasuries are yielding 5%, you expect a pretty high return for those equities, and so you're willing to pay a lower price for them. But if treasuries are 1%, you're willing to pay a higher valuation for those tech stocks because you're doing that comparison. So suddenly when treasuries start rising, you're like, wait, well now I got to pay less for these tech stocks, and so you start to get kind of a sell-off in some of those really expensive names.
It's funny, but it's one of those things where once you start to learn a little bit, you start to get your head around it, you start to see how all the moving pieces work together. And look, I'm nowhere near there yet, Lyn, but I think what it's helped with me is when I read your monthly report now, rather than glazing over most of it and going, I've got no idea what this is about, I'm starting to understand. I'm starting to, like, the pieces of the puzzle are starting to make sense, how it's
I'm
all
glad.
interconnected. Well, thank you. Learn from you. Learning from the best. How you been anyway? Where are we with bond yields? What has happened this last month?
So lately we've been consolidating, and
Okay.
so we got that pretty big breakup, and then they did continue higher from there. More lately they've been kind of going sideways, and so we're below the high level. We got well over 1.7% on the U.S. 10-year. Now we're down in the 1.6% something range. So we've had somewhat of a consolidation. We also had an FOMC meeting, which is where the Fed comes out every 6 weeks and says what they're going to do in terms of monetary policy. And so it was a bigger one than normal because there are a couple of lingering questions. One was that with yields pushing up and with inflation expectations pushing up, the market started to expect that the Fed might hike rates sooner than they said before they would. So before the Fed said we're not even thinking about raising interest rates, and we're looking at multiple years with keeping interest rates at zero, and that's the short end of the curve, right? That's the part that they directly control, and they're saying we're not even going to do anything, and the market's saying, well, like inflation's starting to get a little bit spunky here. And so, maybe the Fed will end up having to raise interest rates. And so they started to price that in. And so when Powell gave his press conference, they basically pushed back on that and said, no, we're really not planning on raising interest rates until inflation actually runs a little bit hot. And so we're not worried about inflation expectations, and we're not worried about alternative ways to measure inflation. They're saying that the way we measure inflation, like the Fed measures inflation, that they're not really willing to raise interest rates until the way they measure inflation is well over 2% for a period of time. The other big thing was that there's a big open question about the SLR rule, which is basically a leverage ratio that applies to banks, and so that was temporarily suspended for a year. meaning that banks could hold more treasuries and reserves than they otherwise could. And that allowed them to essentially help finance the U.S. deficit. That helped basically, if you look at back a year ago in March, the treasury market essentially broke. It became a liquid. They're basically forced sellers, not enough buyers, especially for portions of the treasury market. And so the Fed had to come in and buy literally $1 trillion of treasuries in 3 weeks. And they also worked with banks and said, okay, we're going to take away this cap so that you can, temporarily have more treasuries, and that'll help smooth things out. And so there were some questions about whether or not that's going to be extended. And so I think for a lot of us, me included, our base case was they probably would extend it a little bit, but they actually decided they would not extend it. But then they kind of did a middle of the road thing where they said, okay, we're not going to extend it. However, we're open to comments. We don't want anything to break. So, we're willing to tweak it in the future if it starts causing an issue. And so they kind of took that middle of the road approach, which I found interesting.
How do they measure inflation?
Core PCE. And so it's like, they have a basket of goods, and then they factor out things like, kind of things they view as cyclical, like energy costs and things like that. And so they're saying, what is the non-energy, non-food change in a basket of goods that they define? And there are all sorts of, quirks about it. Like, my understanding is that they use Medicare payment rates as their definition of healthcare inflation. And so there's some wonky things in there that overall probably allow them to understate that a bit, especially if inflation is being driven by commodity prices. And so in general, that would be a slower moving indicator. And so it actually sometimes it's higher than headline CPI if you have a month where you have like oil go negative. Or basically, if you have these kind of big declines in some of these more cyclical commodities, and so you can actually have core CPI be a little higher. Whereas if you have the other way around, where commodities shoot up and gasoline's expensive and people are actually having trouble driving as much as they want to because the gasoline's so high, well, that really won't show up quickly in core PCE unless it persists long enough that then truckers, basically start raising shipping rates, and then that trickles into, stuff you buy on Amazon. And so it's their particular way of measuring it. And so whether or not someone agrees or disagrees with it, at least that's how they measure it, and that's how they said they're going to handle monetary policy until that measure reaches certain numbers.
Do you trust the rate though? Because we're being told that we here in the UK that we haven't seen significant changes in inflation, but I've sat down and talked to a couple of my friends, and we've been comparing certain things that have been going up in price, and we are seeing certain things that we buy go up 5, 10, 15%. All different types of things.
Yeah, currently there's a huge anomaly, and I would say that I think they even admitted in their latest CPI report that they're having trouble collecting data. And there's kind of like weird, like for example, if you look at rents in major cities, those have been down. And those factor pretty heavily into some of these numbers. And so if you were living in New York City and your rent went down, that could potentially offset some of the fact that the other things went up. But if you're not living there, if your living standard didn't change and these other goods are going up, then your personal inflation rate is going to be notably higher, most likely, than the baseline. And so, for example, I did an exercise. It was before this last 6 months of kind of prices going up. But I calculated my household inflation rate over like a 2-year period, and it was something like 3% or so, which was higher than the CPI and the PCE would suggest it would be, but it was lower than some of like the really alternative ways of measuring it. But of course, everyone has their own basket of goods, and so their own inflation rate varies based on their basket of goods. And a general thing we've seen over the past several decades in developed countries is that services have gone up much faster than inflation. So healthcare costs, educational costs, childcare costs, car repair costs, things like that. Whereas the goods have continued to go down or basically undershot inflation. That's due to increasing technology. That's due to offshoring. That's due to automation. And so, for example, you can get a better computer for less cost. You can get a better TV for less cost. You can get a better car for like the same cost. And so those have been deflationary. And so if you're a big consumer of healthcare, education, childcare, like who isn't, then your basket could be, pretty high.
Yeah, my kids, we just got a letter from the school. My kids' education, school fees have gone up, will be going up 4.8%. which is the biggest rise in the whole time either of them have been at the school. I mean, it's a massive rise. I actually spoke to one of the teachers about it because I know him quite well, and I was doing a collection, and he said to me on the side that he said the main reason the cost of the fees is going up is to support the teachers' pensions. He didn't explain why, but he said it's the pensions that's killing them.
Well, a lot of them are underfunded, and so I don't know about that particular one, but a lot of them, they've not put enough money in. Their return expectations are too high, and going back to bond yields, so historically pensions are conservative investors, right? They want bonds in there, and so back when bonds were yielding 5%, you can say, okay, our target rate of return is 7% because we're hoping equities are going to yield 9%, bonds are going to yield 5%. If we do a 50-50 split, we'll get 7%, and it'll be good. But then we say, okay, actually, just kidding, bonds are yielding 1.5%, and then it's like, well, then I need to be more equity focused, and then they get into like hedge funds, they get into all these kind of different alternative investments. Some of them don't work out very well, and so they basically have to go up on the risk curve. And many of them are unwilling to put more money in, and basically, essentially admit that we're going to get lower returns. Therefore, we have to put more money in, or we have to reduce benefits. And so you have these kind of issues build up. And that's happening in multiple countries to different degree. I mean, that happens here in the United States. In fact, part of this recent bill they passed, the 1.9 trillion, there is a section of it for tens of billions of dollars that helps shore up, one of the pension systems. And so it's not directly related to COVID. It's not like a COVID thing, but it's kind of like trying to patch this longer term issue. And going back to the inflation question to finish that up. So I did a piece on inflation back in November, my newsletter. I broke it down into different types of inflation. So you have asset price inflation, then you have consumer goods inflation, and it largely depends on essentially money. If you increase the broad money supply by quite a bit, right? So if you go back to classical definitions of inflation, just an increase in the broad money supply is by definition inflation. And so often when people are arguing about inflation, they have different definitions and then they're talking past each other. So without a doubt, there's been monetary inflation. We've had money supply increases. And then the question is, where does that money go? And the answer is it goes into whatever's scarce at the time. And whoever has the money, what are their needs? And so because we've had an increase in wealth concentration, right? So a lot of that money kind of pooled up in the upper echelon, that a lot of that money went to financial assets. So things like art, wine, gold, high-end real estate, high-end cars, collectibles, equities, all sorts of things like that. Even bonds, because yields went down, bonds went up in price. And so, during that long period of time, we had significant asset price inflation. Whereas, for example, we were in a period ever since about 12 years ago where we've largely been in a state of global commodity oversupply. So our oil's been, it's lower than it was 12 years ago. Copper's lower than it was 12 years ago, even though it's been up a lot lately. It's still lower than it was. It's not at all-time highs, for example. And if you look at a basket of commodities, they've actually been relatively cheap, and that's kept a number of basic goods down. And so more of the inflation's been in the asset price side, and that causes an issue. If you go back to yields, say the housing market, right? If you want to buy a house, my dad, he was an older gentleman when he had me, so he was basically old enough to be my grandpa. But he bought his first house, like he was like a police officer and just like in his 20s and just like bought a house, like it's just like not a big deal. And whereas now, and the price was like silly, even when you account for inflation, like it just basically the ratio of the value of that house compared to his salary, even without a college degree, was a very manageable way to buy a house. Whereas now, because we've driven up asset values, including real estate values, it's harder to buy a house. And the only mitigating factor is that because interest rates came down so much, mortgage payments haven't really gone up in the same way that housing prices gone up. So if your house price doubles, but your mortgage rate is like half the cost, that basically makes it so that your mortgage is more manageable. But that also shows the concern when yields start rising, even from pretty low levels, when housing prices are expensive and people are this leveraged. That makes those houses harder to afford.
Yeah, I mean, I remember my parents telling me the first house they ever bought, because I could never understand it when I was a kid. When they told me this, the first house they bought was £2,000, I think. I could never get my head around that.
Yeah, it's like crazy. Yeah.
Okay, another question on this that's been bugging me, or has been on my mind, is I've got a lot of friends who are in lockdown, and we're about to come out of lockdown, and most of my friends have managed to keep their jobs and been working from home. And most of them are saying the same kind of thing, that they've actually managed to build up quite good savings because they've not, all they can do is have takeaway, right? They can't go on holiday. They can't buy, they could buy a car, but they can't really. So everyone's saying they've got a lot of money. I know what British people are like. Once they let us out, we're all going to go mental. Straight down the pub, on holidays, everything we can do. Could that will obviously lead to a sudden demand, a sudden increase in demand on certain things. Would you expect that to lead to some kind of delayed rising inflation?
It certainly can, yeah. And so, we've had a period, especially there's base effects, right? So back in April of last year, 2020, that was kind of the worst period. So no one was buying anything, other than like Netflix subscriptions if they didn't have one. And so, that
They've
was like
gone up.
yeah. And so that was back then, that was a dip in CPI. Whereas now when we come into April and May, when you do year-over-year comparisons, those are going to be pretty high headline numbers for many countries. And so there's that hurdle to get over. And then two, if you have a large number of people suddenly spending more money on things that they couldn't spend on, that can certainly drive up prices. I mean, for example, I haven't flown anywhere in the past year. I normally would have done an international flight of some sort last year, and that didn't happen. And so, I'm certainly going to do one later this year. And it's people. I think some people will do more than they otherwise would have. They might spend more than they otherwise would have. Those places, because some of the supply has been killed, they can raise prices and say, okay, like there's some of these weaker hotels and folded, and some of the airlines took some of their planes out of flight, and they said, well, there's less supply, so we're going to jack up prices. And so if that kind of happens all at once, that can certainly be an inflationary spike. And you also have to see what happens with energy markets. And so, because we went into this pandemic with a state of energy oversupply, largely due to American shale and Canadian shale, North American shale, that kind of rose over the past decade and kind of disrupted the global, kind of OPEC supply issue that we've had for kind of history. We had a period of oversupply. A lot of it was unprofitable, right? So it's not like we just we grew up on profitable shale, tons of oversupply, and so this comes around and kills demand for the better part of a year, and so we basically had Is
it unprofitable because it's more expensive to get out of the ground than through traditional wells?
That's the thing. The math is wiggly, and so right. What they promise is rarely what they deliver. And so basically, the way that shale works is there's less upfront cost, but then more ongoing costs, because basically it's like a bunch of smaller wells. So instead of say you discover a massive deep sea oil find, it costs like a ton of money to have that rig in place and and get all down there. But then once you put that huge capital cost in, the marginal cost of getting the rest of that up is really low. Same thing with like oil sands in Canada, the huge upfront cost, and then once there, it's actually pretty low. Whereas shale's the opposite, where it's on land. These techniques basically say that you can actually put a small amount of capital up front, and then you get this well. But then what happens is that well quickly starts declining. And then you have to keep putting more and more money in, and it's like they never seem to be like consistently free cash flow positive, and so they basically the whole decade, if you look at the industry, they didn't generate free cash flow, and so a lot of them don't pay dividends. Only like the top kind of blue chip shale companies are able to really kind of pay these consistent dividends, and so it's not been very profitable. But they've had enough. They've been able to raise enough equity from, sometimes those pension funds we talked about, but just all sorts of places have been willing to fund them and just kind of put endless, just light money on fire, keep drilling and just not really getting returns for it. But now you have some investors are just tired of losing money and they're saying, well, I'm not going to invest in that anymore. And then two, you have ESG mandates. So people say, I'm not going to, so like the New York pension system says, we're not going to do oil investments anymore, and some sovereign wealth funds are saying we're not going to do oil investments anymore, and so those companies are less able to just keep issuing equity and just keep drilling, and so they say, wait, we have to actually finance ourselves from selling oil, and therefore we have to be more conservative with our capex, and so we've had this thing where oil demand has risen as lockdowns have eased, at the same time as a lot of that weak supply came off the market. sometimes because CapEx projects were canceled, and just some of those wells kept going down in usage. And so now it's a little bit more tight than it was. And OPEC, some of them can increase production, but they've also purposely kind of held it flat so that they, in their view, hopefully drive prices a little bit higher.
Well, it's going to be interesting to see how it all plays out. I'm planning on going mental. I'm going to go out. We're actually already booked into the pub. Okay, I'll tell you another funny thing. I've got viewer questions for you. This has never happened before. I get people writing in going, "Can you ask Lyn this?" I'm going to entertain it. This is going to be a bit of a jump to a completely different subject, but I'm going to ask anyway. The GBTC Premium is negative. Now, I covered this with Zach, but I still didn't fully understand it. Can you explain to me why there is a premium and why it can go negative? But just keep it as simple as, proper Pete 5-year-old language.
Yeah, sure. So actually, I would go back to pointing out what closed-end funds do. And so before Bitcoin, we had closed-end funds, and basically they're different than an ETF. And so an ETF, the fund manager, they can issue more shares, they can reduce the number of shares very easily, and so it's very easy for market makers to look at their list of stocks that ETF owns, and they can do things like buy all of them and then short the ETF if there's a premium. And they can redeem shares to basically, put a time limit on how long that premium can exist. And so they can arbitrage that down so that ETFs virtually have no premium or discount, other than in extreme market events like March of last year. You had some ETFs have. So whereas closed-end funds are this older vehicle where, basically I raise a bunch of capital. So I do an IPO and I build a company, but all that company is going to do is invest in a portfolio of stocks. And so it's a type of structure that is essentially like an ETF, but it's a different structure. And there's no constant redeeming or creation of shares. It's just that I say I put 1 million shares out there, I got money and I invest in this, and those shares will trade hands, but I'm not issuing or redeeming them. So I go out and invest, and my investments do what they will, and the market trades those shares. But what the market is paying for that basket of stocks might not be the same amount as if you actually add up all those stocks together. The market cap of my company might be different than the actual portfolio value. And in fact, on average, the majority of closed-end funds do trade at a discount to NAV, meaning that you have this pile of stocks, this basket of stocks, and the market is paying 90% of what it's worth or 95% of what it's worth. And so they're actually trading between themselves at a discount. And part of the reason they do that is because that company generally has a fee, like an active management fee that they take out of, and so it's often the case that's 1% a year. And so the market is saying, well, we're going to trade at a discount, and so we're basically going to factor out 5 to 10 years worth of your fee. And so the only ones that end up trading for a premium, especially for any length of time, are ones that are so unique that people are willing to buy into them, even though there's a premium to NAV. Maybe there's a star manager, and they're saying, well, I'm paying a premium for it, but I think she's going to do so well that I think that it's fine for that. Other times, it's just kind of inefficiency. So a lot of those are done by retail investors, and they don't know what a premium is, and they're just buying it. And so there's a variety of reasons why a fund either could be really good or just kind of market's weird. And so now GBTC comes along. They haven't allowed a Bitcoin ETF in the United States. And so we're going to be a trust similar to a closed-end fund. We're going to hold Bitcoin, but they have no redemption mechanism. And so the shares trade for what they will. They hold the amount of Bitcoin that they do. And so those can be separated. And because, it kind of falls into that category of people are willing to pay a premium for it because some people aren't tech savvy, especially the past several years. They don't know how to open a Kraken account, whatever the case may be.
But they want exposure.
Yeah, they want exposure. Many of them say, okay, I want to hold it in my Roth IRA. And so in American, basically, you're a tax-free account, right? And you already have it at Fidelity, whatever the case may be. And you say, well, I want to hold Bitcoin in there, and so by holding a GBTC in their tax-free account, even though they're paying a premium for it, they might say, well, I'm getting it tax-free, and so I'm fine with that. It's a good balance. And so that's been an attractive vehicle for a lot of people. because they don't have to deal with another account. They don't have to deal with custody. And they're just saying like, give it to me. And so there were times where the premium became silly, and there were times where it became lower, but it was generally trading at a premium. But now we've seen more and more funds pop up. So you have Skybridge, you have NYDIG, you have all these kind of other institutions, and also just more and more people are kind of willing to open up major exchange accounts. There's other services like Swan Bitcoin, and there's all sorts of ways that make it increasingly easy and cheap for people to access it. And there's just more education, more podcasting, like what you're doing, and so it's easier for people to open up those accounts. And so overall, I think GBTC's competitive advantage has somewhat diminished, and arguably that they're because they're charging, like last I checked, a 2% fee. I mean, it's a pretty high fee, and some of these other options are lower fees. And so in some ways, that my view is that the market is saying your fee's high, and so we're going to trade at a discount to NAV. That if you're going to charge a 2% fee, we're gonna pay less for those shares now, because we could just go ahead and we could go buy into Skybridge, or we can go to Kraken and just kind of buy Bitcoin there, and then not pay any fees on it other than the initial commission fee and then the sale fee. And so that's taken that out. And what that did was, there used to be an arbitrage where the one way that GBTC made new shares was, if you were an accredited investor, you could go in and say, okay, I'm going to buy at NAV, and so they got to basically buy at NAV. GBTC would issue new shares, pull Bitcoin into that liquid fund. And the only catch was that if you did it like that, you had a 6-month lockup period, so you couldn't sell. And so the trade there was, okay, you say, okay, this thing always trades at a premium. I can buy at NAV, and in 6 months, I'll be able to sell it, and I'll be able to capture that premium. But let's say I don't know what direction Bitcoin's going to go. I mean, some of them would just buy it and hold it because they're bullish on Bitcoin. Other people say, I don't know if Bitcoin's going to go up and down. So what I'll do is I'll short Bitcoin, and I'll buy into this at NAV. And then at the end of the 6-month period, I don't care what Bitcoin did, and my return will be the premium that GBT's trading at, because I'll just sell my shares, and then I can do it again. I can do another 6-month lockup. And so it was bullish for Bitcoin because
okay. Yeah, I get it. Sorry. I tell you the bit that's clicked for me now is I didn't understand the shorting component, because I was like, well, I just didn't understand. It's a bit like if somebody on BitMEX wants to go neutral and they've got a long, they take out a short and they're in a neutral position. They're essentially doing a neutral position, but they're capturing the premium.
Exactly.
Yeah. Okay.
Yep.
That makes
sense.
So
it's nearly a risk-free trade, and they can do it twice a year. And so if the average premium was like 15%, they could get 15% twice a year. And so that's like better than a 30% compounded rate without almost any risk other than counterparty risk. If GBTC's custodian gets blown up somehow or hacked, that's a risk. But basically, besides those kind of tail risks, you're not taking any kind of Bitcoin price risk. And so that was a very popular trade, and it also was good for Bitcoin because it sucked Bitcoin into this black hole. Like it basically, once they go into GBTC, they don't go out, and so it basically was this buying pressure. And now, but because of these increased competition, that premium went away, and so therefore there's no incentive to buy in at NAV, right? Because it's when your lockup period ends, there's a good chance that they're going to be worth less than they're worth now, unless basically there's much better ways to buy Bitcoin than to buy into GBTC above current prices, and so that trade dried up. Anyone who kind of was relying on that trade suddenly kind of might have an issue there. And so now, but some of those lenders are smart, and so they would position themselves so that we're only going to put a certain amount of capital in this GBTC trade. Any good one should have modeled like what happens if that goes away, and so we might have to lower interest rates, might have to do other things, but it's not like they're going to blow up. And now there's potentially the other side of the trade. I mean, so one thing's that if a closed-end fund gets to a very large discount to NAV, that makes it more attractive, because you say, well, like I can do that. And then there are some ways that those closed-end funds can close that discount. And so before I said they don't really issue shares and stuff, but as an exception, they can. They can say, well, our thing is now trading at a 15% discount to NAV. Let's say there's a I often use the example of an Indian fund. They invest in Indian equities. They're often trading at around 10% discount to NAV. If there's an unusual period where they're trading at 15% discount to NAV, the fund manager can say, we're gonna buy back some of our shares, and that helps close the gap. And if for whatever reason it trades at a premium to NAV, they could actually issue shares and they can kind of play that arbitrage. And so they can buy some of the shares back to try to close that gap. And then also if the United States ever allows a Bitcoin ETF, which it seems like the writing's on the wall that eventually, there's so many people applying for one. Canada has one. It's really hard not to have one. So if there's ever a Bitcoin ETF, if GBTC is able to convert into an ETF, that discount should go away. And so people can do a thing now where they buy GBTC at whatever discount it's at, and then they can short Bitcoin. They can have a neutral trade with the expectation that in the long run that gap might go away.
So okay, so do you think an ETF is coming? Because was it like 17 applications out now? And didn't Fidelity just apply for an ETF?
I heard that Fidelity did, yeah.
Yeah.
And I assume one's coming, and I admittedly don't know how it works when everybody wants to, I don't know how they pick who gets to have one. I know that so for most asset classes there are multiple competitors, right? So there are multiple gold ETFs. There are and they might have slightly different nuances. And usually what happens, for example, if you look at gold ETFs, there's like the original one. And that one's super liquid, right? So if you're doing option trades on that ETF, that's the one you go to. But they can get away with charging a higher fee for that. Whereas other ones come along and say, hey, we're going to do the same product for half the fee. And so that's more attractive for long-term holders, but that'll generally be because it's a newer product, it's a smaller product, it's less liquid. And so, frequent traders and option users will generally stay away from that product and they'll stick with the older, more expensive, more established product. And so whether you're a buy and holder or you're a trader, which one could be better? And then you can have other funds come out and say, okay, we're going to actually fully allocate our gold, and so we're better, but we're going to charge a pretty high fee. And so some people that are concerned with rehypothecation and things like that can buy into that fund. And so you have these different trade-offs between these different types of funds. And so you could see that to some extent in the Bitcoin space. We have multiple ETFs once they're allowed to use that asset class as an ETF.
So whoever gets if it's one, everyone else is going to be so pissed off.
Yeah. I don't fully know the mechanism of how that selection process works and who's going to be allowed and who's not. The first big question is whether or not they let anyone. But I think eventually they have to. It's hard to, yeah.
Well, somebody put out a great tweet the other day. I think maybe it's Frank. Not Frank. Oh, here we go. Given all the bullshit that's gone on with the meme stocks this year, if the SEC doesn't approve a Bitcoin ETF, they are either completely ignorant, complacent, or corrupt. I thought that's pretty fair.
I think it's fair, and there's been good comparisons, because one of the ostensible things is we're not going to allow a Bitcoin ETF because it's too volatile. But there are like triple leverage ETFs that blow up all the time. There are volatility ETFs that have this massive decay rate. There are all sorts of, then now we have meme stocks being grouped into an ETF, and that, it's kind of this weird construction process and just kind of a questionable product to begin with. And so overall, there are a ton of weird vehicles out there. And so Bitcoin would by no means be the most volatile one. I think that the concern they've been going with recently and for a while is that they've been concerned about market manipulation, that they want to make sure it's not a market that a small number of individuals can manipulate. And so back when Bitcoin was smaller, it was easier for whales to manipulate it. But the bigger it gets, the harder it is to move. You still see periods where, there'll be an alert put out saying, Gemini just got a whale input. And I know Willy Woo is always on Twitter saying that's not what happened. So
I talked to Willy about that yesterday, about them crashing the market, the quant guys, because that's twice they've done that. They did that with the F2 pool data.
Yeah. So, and unfortunately that kind of gives that's fuel for the SEC to be oh, look, it's manipulated. That's why we have to hold off on an ETF for now. And so basically the extent that a market could be kind of manipulated, especially the type of manipulation they care about is that short-term stuff. If a group of individuals could say we want to short it and then move the market and then get whatever they're going to do, that's one thing that I think the SEC has reasonable concerns on. But really, it's like there's so many small stocks out there that can be manipulated. There's so many kind of weird vehicles out there that can be manipulated that Bitcoin would by no means be the problematic one. And so and so I think eventually it's inevitable, but we'll see.
Do the ETFs have to buy the underlying asset?
Well, they can have exposure in several different ways, and so one example is that there are popular commodity ETFs, right? So there's an ETF that follows a basket of agricultural products, right? And they don't have giant warehouses of grain and soybeans. Instead, they use futures.
Okay.
And same thing with some of those oil ETFs. They don't hold a lot of oil. They buy oil futures, and some of them actually kind of blew up for that reason. So basically, there's all, and there are future experts. They can go into way more than me. But basically, if oil's in a bear market, if you look at the performance of those oil ETFs, they do way worse than oil. And it's the way that the futures worked as they rolled from one contract to another. They basically had this stepwise like downdraft in their value. So if oil were to say get cut in half, right? So it goes from $60 a barrel down to $30 a barrel, and then it say doubles again, so it goes back up to $60 a barrel. You would expect that the ETF also got cut in half and then doubled. Whereas really what happens is like the ETF like goes down like a little bit more than half and then only comes back like part of the way. And so that had like a permanent capital loss based on the fact that they're using futures rather than holding giant tanks of oil. And it partially comes down to the stock to flow ratio of that commodity. And so gold is one where at least some of them like Sprott can hold. They're like, we have an actual vault, the metal's in the vault, and that's how we're doing this product. Other ones a little bit more questionable. They can say we have a vault, but we also use a little bit of derivatives around the margin because whatever the case may be. And so it really depends on the type of asset that they're doing. And so there are uranium holding companies, so that's got a pretty high stock to flow ratio, so they can actually physically hold it. Gold, silver, uranium. Whereas if you get into those oil, copper, grains, they're almost never going to be holding it. It's going to be futures based. Now Bitcoin's one where obviously they can hold it. Something like Fidelity can be like, hey, we have our deep cold storage solution, and here's an ETF. Now they also could do other options as well. They could do options and futures to basically synthetically have that exposure. And that might be one of the differentiators between different types of Bitcoin ETF. Like people can say, I like Fidelity's, but I don't like such and such because I like the way that they custody it more. And so that could open up some differentiation, either in terms of, so some of them might be more expensive, but arguably better security, as an example.
Okay. Well, I think they should just let them all go at once. I think they should set the rules up front. Say, look, if you want to follow these rules, you can go live, and just let them all go.
Honestly, I don't know how it works when multiple of the same want to do a similar ETF. It's not something. There's industry experts that would be able to know that specific process way more than I would.
Would you expect a supply shock when they are veiled on the market? Do you think there would be a lot of demand for this?
I think there's gonna be a lot of demand because, as an example, I remember we talked about the MicroStrategy thing where. Like if an ETF like GBTC trades over the counter, right? So not only is it not an ETF, it doesn't trade on the New York Stock Exchange, it doesn't trade on NASDAQ, it just trades over the counter. And so, for example, I have different model portfolios, and one of them uses M1 Finance, which is a good platform, but they can only go on the major exchanges. And so I couldn't even have GBTC in that account. Whereas my other brokerage, Interactive Brokers, I can go ahead and buy GBTC. Whereas I'd rather I'd also want to have that in my M1 Finance account, but because I couldn't do that, instead I bought MicroStrategy back in like August 2020 because they became a Bitcoin allocation essentially, and so that was one I was able to actually access on that particular platform. So if there's a Bitcoin ETF that then trades on a major exchange, more people can essentially access it than they would if they're not willing to buy over-the-counter products, and if they're not interested in having like a exchange account or something like that. And so it should increase overall demand, especially like RIAs, like asset managers that basically invest other people's money. An ETF makes it much easier to be inserted as a slice into a diversified portfolio and say, okay, we're going to have a 2% Bitcoin allocation via this Bitcoin ETF that's backed up by BlackRock or Fidelity. We know whoever ends up kind of getting that, and so that gives them much more kind of comfort, I guess,
Right.
and potentially better liquidity and things like that. And so it should result. I mean, the Canadian one did very well for
Yeah.
that sort of reason, and you'd expect that the American one would add a zero to that probably,
Mm.
or at least if there's like 5 of them, then it gets distributed across multiple ones, whichever ones end up being the popular ones.
All right, I do want to go back to bonds. Actually, I got a question on this. Somebody asked, and it's something I'm like thinking about, but based on talking to you and talking to Greg, and I've got a follow up based on my conversation with Greg. But is there a looming corporate bond debt crisis?
Potentially. So if yields keep rising, if inflation goes up and yields rise, that can put a lot of pressure on credit markets. And so a number of people have been talking about the possibility of yield curve control, including me, where the Fed can go in and prevent long-term treasuries from rising. And a couple of us like me have been pointing out that they're unlikely to do that unless something breaks. So it could be that the treasury market breaks, or it could be that credit markets break. And so, for example, if you look back at Q4 2018, we had a big sell-off in asset prices, especially growth stocks. And Powell did his famous Powell pivot, where he said, we're basically that was all sparked by the Fed was raising interest rates. They were reducing their balance sheet. They're doing quantitative tightening. They kept saying it was on autopilot. We're going to keep doing this. The market freaked out, and then Powell came and said, we're actually we're going to be more data dependent. We're going to slow down. And that kind of eased the market. Now, a lot of people think that Powell did that because the S&P 500 fell 20% really rapidly. But actually, the bigger concern was that the junk bond market froze up. And so for 6 weeks, there were no junk bonds issued in the United States, and I think probably a lot of other places too. And so basically, that's a bigger issue than equity prices going up and down. And so when they see the credit market freaking out, that forces the Fed to kind of intervene more. And so there's a lot of corporate debt in the system relative to GDP in many countries. And one of the ways that they've been able to do that is because interest rates are so low. But if interest rates keep pushing up, that does put some pressure on them. And so I would expect to see some turbulence in some of those areas. And last year, the Fed was able to buy corporate bonds, even though they're technically not supposed to. They did a loophole where they set up a special purpose vehicle with the Treasury. The Fed can't do it unilaterally. Only the Treasury and the Fed together can do something like that. But even then, they didn't explicitly buy junk bonds, but they were like, okay, we're going to buy investment grade bonds, but if they fell to junk like in this certain period, we're also willing to buy them. And they actually ended up not buying a ton, but it was enough to like soothe the market, where they basically the market took over and kind of pushed those yields back down. And so there is kind of a long-term issue of debt. And if you look at an example I often use is Japan, where they had a huge corporate debt bubble 2 decades ago. And part of the reason they stagnated is because they've been deleveraging that over time. So even as Japan's sovereign debt skyrocketed, their corporate debt as a percentage of GDP and absolute went down, because essentially you had a transfer from the private sector to the public sector. And so over time it is possible we see a similar thing in some of these other countries where corporate debt's pretty high and should ideally flatline or start going down as a percentage of GDP. And whether or not that happens abruptly or over time remains to be seen, partially dependent on what policymakers do.
Have you seen Greg Foss's theory on Bitcoin as insurance on the spread of bond yields?
I don't think so, no. So it's basically like he's saying if yields go up a ton, like that volatility would be good for Bitcoin.
Yeah, he's saying that essentially you can use Bitcoin as an insurance against it.
Yeah, potentially. It's one of those tricky things, because if you have a volatility event that causes illiquidity, like we had in March 2020, then Bitcoin can go down with everything else, sometimes even more because it's Bitcoin. Whereas if you have other types of issues where it's not a liquidity issue, but it's a solvency issue, that's generally good for those hedges. And so as an example, if you use gold, back in that sell-off in 2018 that I talked about, gold did very well because it wasn't a liquidity issue. It was like a yield. Basically there was like a variety of issues, but liquidity wasn't really one of them. And so something like gold was able to do well. Whereas in March 2020, gold sold off with everything else because it was a liquidity issue and people had to force sell certain things. And so in a similar way that for Bitcoin, if there's like a solvency issue, Bitcoin is likely to do pretty well. If there's a liquidity issue, then Bitcoin can temporarily be correlated to other assets in the market. But I'd have to see the specific theory about the credit spread.
What do you think of NFTs?
So yeah, I was asked that on Real Vision too. Basically, it's an interesting technology. Like it's I'm always open for ways that artists can get paid for their creations, whether it's music, whether it's video, like visual files. There's a couple issues. One is it's actual the problem with digital art is that you can get an identical version rather than just like a similar copy. And so, for example, if someone has a Van Gogh, another person can get a very good replica of Van Gogh, but it's not identical down to the brushstrokes, right? It's very similar to an untrained eye, but it's not an identical product. The problem with a digital NFT is that you literally have the identical JPEG, and you just don't have it signed essentially. And the other issue that I point out is that basically you're also betting on the underlying blockchain that it exists on, because if say there's like a Picasso painting, but he used the wrong kind of paint, and so that's dissolving faster than expected, and so and that happens sometimes. They're like
yeah, no, it's just a great analogy.
And so you say, okay, I love Picasso, but the canvas is bad, or like the paint's bad, and it's falling apart rapidly, and that would take away from the value of that Picasso. And so if your NFT is built on a blockchain, you better hope that blockchain, and if you're going to pay $1 million for it, or tens of millions of dollars for it, you better hope that blockchain's around for the next 50 years, right? So based on how much you're paying for it, you better hope that blockchain continues to be the leader in that field. And so it might not have to be the biggest blockchain. It might be, say, the biggest utility blockchain, but it better not get displaced by competitors over the next 10, 20 years. Otherwise, that really takes away the value of that product. There's another thing where traditional art, usually, unfortunately, living artists don't sell their art for a ton of money. It's usually when they pass away, and then their art starts getting exponentially more expensive. And that's partially because you just proved scarcity. Right, so that artist can't make any more, and so
never thought of it like that.
Yeah, and so those go up a ton, and so we have the overall question: like, if an artist does an NFT, could they issue another one on a different blockchain? Could they just? There's all sorts of issues like that, and so overall, if you step back for a second and say, okay, people love collectibles. We're obviously willing to pay money for things that are worth more than their materials, and everything's being digitized. It would make sense that there's some foray into digital collectibles. That makes sense. But then the question becomes, how do they work? What are they built on? What is their mechanism to ensure that it's actually scarce? And then also, is it a mania? Are the prices reasonable? What is the probability that most of these are going to hold their value over the next 5 years? Well, some of them perhaps, but I think a lot of them are, not discernibly priced, let's say.
All right, I think we can do one more topic, and then I'm going to let you go. So, nobody's talking about Tether anymore. The Tether FUD is over, which is amazing, really. I've just not heard. I can't even remember the last mention of Tether. It's all gone. So
I see the occasional Twitter comment, but that's about it. Yeah.
Probably from someone misinformed.
Yeah, and my inbox is like, before there was when that big article came out, I got like 1 million Tether questions, and I haven't gotten one in like 2 months.
Well, I'm getting a lot of energy questions at the moment. People saying, "Can you just cover energy? Can you make a show about energy?" Which I am going to do, but I think we are seeing a different type of FUD, which is the governments will ban Bitcoin. We've had whatever Mike Green wants to talk about, but Ray Dalio specifically. What are your feelings on that? And also, how did your debate/discussion with Mike go? I haven't watched it yet, but I'm going to certainly watch it.
So I enjoyed it. I mean, that one had an institutional audience, and so it was actually we've structured that more as a conversation than a debate. But of course, we had opposite sides of a conversation. And so I think it probably was similar in tone to when he discussed with Nick Carter.
Hmm.
And so I haven't got a chance to listen to it back. So, it's a basic conversation about the risks and kind of defenses against those risks. Like he pointed out a risk, I would say, well, here's why I don't view that as a primary issue. And so we kind of walked through that for it was only like an hour or two, so we didn't exactly cover everything. But I'd recommend people checking out whenever I think it's going to be posted on YouTube at some point if it hasn't already. And so overall, with the government banning FUD, this has been a long known concern within the Bitcoin community. It's not like people haven't thought about it, and of course we have seen smaller countries do different attempts to try to ban it. You have kind of issues there where people often point out that it ends up trading at a premium there, and so it actually doesn't reduce the price. The latest big one is India looking to ban it. They had kind of a failed attempt before where the Supreme Court kind of knocked it down. This is like attempt number 2, and so we'll see how that goes. So in one sense, a country can't ban Bitcoin; they can just ban themselves from Bitcoin. They can just exclude themselves from it. Yeah, and they can only do it part of the way because it's really hard to enforce because it's just information. You're banning information, which is really challenging to do. Now, the big concern that people have is what if the United States bans it? And unlike, say, India banning it, if the United States somehow came out with a ban, it would be, at least in the intermediate term, bad for the price because you'd have forced selling. It's not like India holds a massive amount of Bitcoin. It's not like there's like multi billion-dollar institutions that it just have to just divest billions of dollars of Bitcoin. And so if the United States did it, that would be likely a massive price shock to the protocol. And so we would see how that would develop. Now, the problem with the United States banning it is it's hard to do because, essentially a ban on Bitcoin is a capital control. So that's tricky. And it's also you're banning information, right? So you have to get that through, you would have constitutional challenges against that. And so overall, I view it as there's a spectrum of options, right? So on one hand, the direction they've gone in, to their credit, is to say, okay, Bitcoin's here, it's a digital commodity, so we're going to tax it like a digital commodity. We want to, they want to know who's trading it around, which is natural for governments always do that. And so, and that's actually one thing I talked about with Mike is basically that, a lot of the criticisms about Bitcoin privacy could be leveled at cash, right? Governments aren't super popular about cash either. And so there's been basically KYC laws and things like that. And so those are some of the more benign restrictions on it. Then you can kind of go up and say, okay, what if they say, okay, we're not going to ban it, but we're going to put all sorts of limitations on institutions being able to own it. And so that's a much easier thing to enforce because you're no major institution is going to do something that's against the law. And so it's enforceable and it's less freedom restricting on individuals and less capital controls. And they just say, okay, if you're a fund over this much, we consider it too risky to have Bitcoin, and therefore, screw you. Now that's still a pretty extreme option, right? Because they can put limits on, how much can be held in order for it to be like open to kind of criticism. They can do things like that. So that's the more realistic thing I'd be concerned about is basically things that slow down institutional adoption, because that would overall be what would affect one of the demand drivers. And whereas an outright ban seems very challenging, and it's one of those things where one of the arguments is that the bigger it gets, the more likely it is to get banned. But the alternative view that I've taken, especially since my articles back in like mid 2020, was that the bigger it gets, in some ways, the harder it gets to ban, right? Yeah. Because once the donor class owns it, so right, all the political donors own it. Once there's like Bitcoin senators, once it's firmly entrenched in Fidelity, NYDIG, BlackRock. Someone has a Bitcoin ETF, maybe. There's like banks custodying it. There's, let's say, Coinbase goes public, and then you have this big, entity built around it. You have corporations with it on their balance sheet. That gets much harder to outright ban because then you're going after the capital of the donor class, and so that actually becomes very unlikely. And so my main concern is kind of watching these other types of activity that are lower on that spectrum. That would essentially put brakes on institutional adoption and things like that. I think those are the more realistic concerns to keep an eye out for. Also, we had the scare, during the end of the Mnuchin's period where they were kind of pushing things that would make self-custody harder. And so I think the bigger concern is around the margins rather than something like, it's illegal for Americans to own Bitcoin. But people have to keep everything on their radar because there are countries like India that are pushing forward with that sort of thing.
It's going to be really interesting to play out. I think that's one of the most interesting things to track this year with the increase in adoption. But my view is like, if it would be cutting off your nose to spite your face for the US to ban it, because so much of the wealth of Bitcoin is now held in the US.
Exactly, and that's
economically damaging.
And that's some of the education that people have been using, and that's also that's part of what I say, that the bigger it gets, the more wealth you're destroying if you try to ban that. And so you basically have to hope that regulators realize that, and that they see that the United States owns a ton, Europe owns a ton, that them trying to ban it would actually, in many ways hurt their own citizens, their own institutions, by reducing the price of an asset, at least temporarily, that a lot of their people own.
It's a whole bunch of stuff I haven't got through there. I wanted to talk to you about network effects. I wanted to talk to you about fee-based security. We're just going to have to wait till next month.
Yeah.
Lyn, as ever, it's amazing. I've learned so much. You're the best. You really are the best.
Happy to keep coming on.
Yeah, this is amazing. People love it. The show last month did something like 90,000. Everyone is going higher. We better crush 100,000 this time. Listen, have an amazing month. I'm sure I'm going to see you everywhere and talk to you before then, but appreciate you coming on. Everybody loves your show that you're doing here, so thank you so much.
Yeah, thanks for putting it together.